Hi. My name is Venkatesam. I am a CFP from Hyderabad city in India. In this webinar, we shall be discussing the Client First Code of Ethics for Certified Financial Planners. While the Client First principle is universal and easily relatable to the practice of the profession everywhere, it is possible that during this webinar, one or two examples or instances may roll in that may be more relevant to the Indian context. In this webinar, you will learn and understand the importance of the Client First principle, its relevance in an advisor's practice, application of this code of ethics in the financial planning process, importance of Client First while making product recommendations, standing out in this noble profession, and the key traits of an efficient and successful advisor. The Financial Planning Standards Board defined 8 codes of professional ethics for certified financial planners. These 8 codes of ethics are: Client First, Integrity, Objectivity, Fairness, Professionalism, Competence, Confidentiality, and Diligence. Client First simply means putting a client's interests before the professional's own interests. Be it any profession: medicine, law, engineering, chartered accountancy, financial advisory, or for that matter any profession. The professional is expected to provide the best advice and service to his or her clients. You can see here that Client First is the foremost code of ethics that FPSB standardized. Now, let us carefully look at these 8 codes of ethics. Though Client First is at the top in the list of 8, these principles are not in isolation and hence these must not be read and understood as independent. They must always be read in relation to one another. But, what does that mean? Let us take integrity for an example. Integrity means honesty or truthfulness. If a financial planner has no integrity, if he or she is not honest, how can we say he or she puts clients' interests before his or her own personal gains? It is not possible and practical. So, Client First is directly related to the implementation or the practice of the Integrity Code. Similarly, take competence. When we say competence, it means having aptitude or proficiency, being adept. That is, the financial planner must be thorough with all the fundamental aspects of personal financial management. A financial planner may be said to be a jack of all trades, master of personal financial management. He knows every aspect of personal financial management. So, if a financial planner is not competent, if his knowledge is not contemporary, if he does not critically understand various aspects of individual money management, how can he put his clients' interests before his own? How can he deliver the best service and advice to his clients? It is not possible. Again, look at professionalism. FPSB says, professionalism means acting in a manner that demonstrates exemplary professional conduct. Professionalism requires behaving with dignity, and showing respect and courtesy to clients, fellow professionals, and others, in business-related activities and complying with various appropriate rules, regulations, and professional requirements. If a CFP does not meet this professionalism code, can we expect him or her to provide the best advice and service to the clients? It is impossible. We can say with confidence that the Client First principle is clearly integrated and in sync with the rest of the codes of ethics, which is why it is at the top of the list. Let us understand the scope of Client First principle in an advisor's approach towards a client. There are at least 4 aspects to this. 1. Fearing about educating clients. 2. Concurring with educated clients. 3. Charging a fee from clients. 4. Give away pride and collaborate. Most financial advisors are averse to educating their clients for the fear that the clients may go independent. They fear they may lose clients if they educate them because the clients may do their own research, get information online, and take financial and investment decisions on their own, which can hurt the career and practice of the professional. Another reason is, they fear clients may ask questions that the advisor cannot answer. When asked about this, advisors often cite wastage of time as a reason. But what they do not understand is that educated clients save a professional a lot of time. If a client is educated, the advisor need not waste further time in convincing the client to take a timely informed decision. Most advisors miss the point and abstain from client education. When a financially educated client, out of his or her own experience or learning makes a statement, or puts up an argument that does not suit the client or fit into the plan, some advisors agree with the client's decision for the fear of hurting the pride of the client and losing business. What they miss is a client is a client whether educated or not. A CFP is a professional. He or she must give confidence to the client that the advisor can advise the client, and not take advice from the client or be intimidated by the client. If the client is wrong as regards any past or proposed financial decision, the CFP must have the courage to tell the client in a pleasant and acceptable tone that the client's statement or view is wrong for a reason and has a negative effect on the personal finances. This is very important. Clients do not pay a fee to the advisor for agreeing with them. They do not pay for inefficiency. Do other professionals do this? Do doctors do this? Do we put up an argument with a doctor when he recommends a medicine or diagnosis or treatment? No. A doctor is an expert in his own field. We may read something on the internet, we may have read a book, we may know a few things about healthcare, and we may be eating medicines, but merely for that, we do not argue with the doctor, question his prescription, or challenge him. Do we? So is the case with a lawyer. Professionalism and experience. That is why we pay them a fee. A financial planner is no different from such other professionals. However, a CFP must be commanding and equally competent in his own field. A financial advisor may have a professional income in either of the two ways. He or she may be depending solely on the fee charged from the client for the financial advice and service rendered. Such a practitioner is called a fee-only advisor. But when we say fee-based, a financial advisor may have a different or additional source of income, in the form of a commission or brokerage from various financial product manufacturers for recommending their products to clients. Some advisors may have both types of income from a single client, often without the knowledge of the client. A CFP must remember well that it may not be wrong to charge a fee worth his time and advice and also earn a commission from the sale of product manufacturers, but he must always remember to be transparent and fair in his advice and service to the client and never exploit the trusting and unsuspecting client. Every financial advisor may not be an expert in every aspect of personal finance. So, in the course of his profession, a CFP may be required to consult and collaborate with other professionals to give thorough and complete advice to clients. For example, a CFP who is not an expert on tax-related matters, to give the client, may consult a chartered accountant or tax consultant, seek their input, and include such advice in the plan. However, any disclosure of a client's information to such other professional must be done only after getting written consent from the client. The CFP must not allow pride or any personal emotion to affect the quality of the plan, and not abstain from collaborating with other professionals. Obviously, such behavior does not sync with the client first. In the previous slide, we saw what the client first means as regards an advisor's practice. Now, let us look at some examples from the financial planning process point of view. We shall understand how client first principle is inseparable from 1. Risk profiling and asset classification. 2. While making recommendations. 3. In goal prioritization. And 4. Based on the fee or income received from a client. Casual risk profiling and asset classification. Whether it is a regulatory requirement or not, financial planners and investment advisors across the globe have a practice of risk profiling, including any investment-related recommendations or advice. Risk profiling of a client is usually done through a standard questionnaire either designed by the advisor on his own or adopted or borrowed from another professional. Through the questionnaire, the planners ask a few questions, and depending on the responses given by the client, they apply a certain asset classification model and define an asset classification strategy. Based on the responses given by the client to each question, they assign a score and conclude whether the client has low tolerance or moderate or a high appetite for investment risk. Now, here, to implement the client-first philosophy in risk profiling and asset allocation, a CFP must and review the risk profiler or questionnaire first. If we study various questionnaires used by planners around the world, we see questions such as, "What is your age?" Now, what has age to do with the risk profile of a client? Not in theory but reality. A person may be 80 years old, but he may still be well off and has high tolerance or even appetite for investment risk. But the moment the age of the client is put into the questionnaire, it becomes a decision-making factor for defining the risk profile of the client and subsequently creating an asset allocation strategy. As the client is old-aged, naturally the profiler may allot a low score indicating that the client is a low risk taker, of course, in conjunction with other questions in the program. So, when a CFP does risk profiling for his clients, he must make sure that he is not doing it merely for the sake of it or as a formality. He must thoroughly study all the questions, periodically review them to ensure they relate to the contemporary professional world and general lifestyle. Just because some other CFP is using a questionnaire, does not imply that everyone cannot use the same. We can have our own questionnaire. What is important is, the questionnaire must be practical, meaningful and logical. That is all that matters. If the questionnaire is not correct or incomplete, the output will be wrong, meaning, the risk profile identified will be wrong, and so will be the asset classification. Making recommendations based on thumb rules. We all know life is uncertain. Most people that have ever met a life insurance agent or a relationship manager, whether they bought a policy or not, may have heard from them a thumb rule that life insurance cover must be at least 10 times the annual income or 15 to 20 times the annual expenses, and so on. Understand that life is not so simple that we can manage it on thumb rules. For example, in India, a caring father, regardless of his financial position and income, manages to provide for his child's education or the girl's wedding. If life insurance is bought based on thumb rules, critical needs such as this will never get addressed sufficiently. A true, experienced, and concerned financial advisor must know and remember well to not recommend or depend on thumb rules. Whether the discussion with any person whosoever is casual or serious, never appreciate or encourage thumb rules. However, some confusion exists regarding thumb rules. For example, there is a calculation that tells how long it takes an investment to double in value, given the interest or rate of return. The math says, 72 divided by the interest or rate of return gives us the number of years it takes for an investment to double in value. It has become a practice to call this a rule of thumb or a thumb rule. A CFP or an advisor must be able to differentiate between math and an actual thumb rule and only reject the latter. Goal planning based on a client's needs and priority. It is undisputed that financial needs and goals form the crux of the financial planning process. The energy of the head of a family and the strategies of an advisor constantly revolve around goals, finding suitable ways to achieve them. Such is the importance of needs. So, the advisor must help the client prioritize the identified and quantified needs and goals. However, in the process of constructing the plan, the advisor may find some goals not achievable due to financial constraints in the client's current or projected cash flows. In such a case, a fee-based advisor must not suggest the client to make provisions for such, which will give higher revenue to the advisor upon selling certain financial products to the client. For example, a client may have two needs, namely child higher education and retirement annuity. Merely for the fact that the investable amount for retirement is low and being farther away than the education goal, the advisor must not mislead a client citing education as a more important need to provision for, as it also has lesser time to achieve it in comparison to the retirement goal, which will allow him to sell a product that will earn him a higher commission. This is worth mentioning because some fee-based financial planners who chase money may get carried away in the course of their business, lose direction and get used to prioritizing selling of financial product client-centric advising. While it is not a moral thing to do, such practice also violates the FPSB Code of Ethics. Financial advice commensurate with advisor's fee. In the present fast-paced world, time is money. And this undeniable statement alongside others holds true for the financial planning profession also, whether the reference is to the practice of an advisor or the financial goals of a client. World over, financial planners charge fees from clients in different ways. However, a common thing in the advisor community is that some financial planners may charge a different from each client depending on the scope of the plan or the time spent on constructing the plan and service rendered to the client. Those who charge based on the time consumed to construct the plan may charge the fee by the hour, but not change the hourly fee from client to client. In the process, an advisor may earn a higher income in the form of fee as well as commissions from the sale of financial products, while some clients pay a lower advisory fee and not buy any financial products. In such cases, it is agreeable and understandable if an advisor spends calculated time on each client, commensurate with the fee paid by the client. But in no case, a CFP must ever compromise with the quality of the advice and its suitability to the client's financial goals merely for the fact that he or she has received less fee from the client. A CFP must ensure that the advice or plan given to a client, when audited by an independent authority or another practicing financial planner, must. In this section, we shall understand how goals must be provisioned and what a CFP must do to help clients achieve their financial needs and not jeopardize them instead. In life insurance, if there is any savings element in a non-market linked plan, it is an endowment plan by nature. These plans come in various types such as whole life plan, endowment plan, marriage endowment plan, money back plan, etc. In India presently, though, the benefits on such plans are illustrated at an estimated 8% and 4% per annum, the actual internal rate of return may turn out to be between a meager 4.00% and 4.50%. With high inflation rates killing the purchasing power of the hard-earned money constantly and the central bank curbing interest rate on deposits, advisors must reflect and decide whether the schemes that appear lucrative on paper are worth investing or not. Merely because life insurance companies pay very high percentage commissions to agents and brokers on such insurance plans in comparison to other financial products, financial advisor must not recommend or sell them to client, citing tax deduction benefit under the prevailing income tax rules. Financial product selection is a complicated affair. Success of the entire meticulously drafted plan depends on the selection of apt financial products. Before making an investment, one must study its features and check if the product meets the goal requirements. For example, the product must be liquid. That is, the client must be able to sell or redeem or close the investment without any significant loss when the money is needed. If the investment has a specific maturity, one must make sure that such maturity occurs before the goal year or at least in the goal year. Investing in a product that is locked for 10 years while the goal to which the investment is allocated is due in 8 years is bad. In such a scenario, one is forced to borrow money for proportionally higher interest rate by pledging the apportioned investment, or else some other liquid investment attached to another need or goal will have to be broken to accommodate the goal that is due immediately. A product distributor might have a pounding heart while closing a deal with his client and jumping in joy, but a financial planner must never act in a hurry while recommending a product. Choosing a financial product to achieve a goal is a crucial part of financial planning process. We do not directly associate products to goals but divide them into distinct categories and understand them individually. That is because, sometimes a specific product type can be used to address more than one financial goal having varying time horizons, while a product designed to address single financial goal may not be suitable in one's case due to differences in maturity period or return. Life insurance products are not transferable from one agent or advisor to another. But such is not the case with all financial products. For example, non-life or general insurance plans such as health or motor insurance are yearly plans. That means, every year after the expiry of the one-year plan, the policyholder can buy a plan by buying a new one from any other insurance company through a different agent or broker. A similar thing happens in mutual funds. Distributors are always on the prowl for opportunities to acquire new clients. If they encounter any client who is not satisfied with the services of the current broker, or if they can convince the client that they can better advise them, the client can shift the mutual fund portfolio to the new distributor or broker. But, as the new distributor cannot get any commission or brokerage on such transferred assets under management from the mutual fund companies, they will have to find a way to convince the client to switch the investment to a different scheme, saying the schemes in the current portfolio are not suitable to the client's risk profile or return requirement or some other reason. It is not that selfless and genuine advice does not exist, but only that such an opportunity exists in case of some financial products where sales personnel or distributors can mislead the client for their personal gains or to achieve business targets. A CFP or an investment advisor must clearly such practices. After a few meetings, clients generally trust their advisors. Most clients do. When a client trusts you, do not do anything that harms the client. Whether the client is paying you a fee or not. Whether you're earning any revenue from the sale of financial products to the client or not. When a client trusts you, do not exploit him or her. You may charge a client who can afford a fee, in addition to earning a commission from the sale of financial products. But if the client is unwilling by your advice or services, or the client cannot pay a fee, either tell the client outrightly that you cannot provide any advice or service, for time is money for you. If you are kind, or if you can spare some time, you may provide pro bono services without any service and not sell any products that damage the achieving of financial goals. But never exploit a client, particularly someone who trusts your judgment and advice. The client first principle is thus encoded in all the other codes of ethics. A CFP must not be a crowd advisor. He is never one in the crowd. He must always stand out, meaning, not replicate the general practices of every other advisor in the profession. A financial planner or a financial advisor must do his own research on various tenets of personal finance, question the findings, and find answers on his own, which will be hailed as logical and original, and accepted by the peer group globally. For instance, If a financial planner or an investment advisor is doing asset classification based on the risk profile of a client, he must think practically and not blindly go by the routine. Imagine an individual who is in his mid to late 30s. He has at least 20 before retiring from active service. All his goals are due in the long term, that is, at least 10 years away. Most advisors agree that equity in the long term is less volatile and returns high reward in comparison to all other asset classes. Now, the client also has a very high tolerance and appetite for investment risk. The client is young, his goal due in the long term, and he has high risk tolerance. In such a case, is there a need to do asset classification and apportion some percentage of the investable surplus to equity, some percentage to debt, and some to gold, and so on? Is that really necessary? It must be remembered here that I am not referring to short-term goals or needs such as savings for creating a contingency fund, but to long-term goals. I am not saying whether doing asset classification or not doing it is right or wrong. All I am saying is that a CFP must think, question and evaluate the principles and established practices to ensure he or she delivers the best advice and unchallengeable financial plan to clients. Similarly, a majority or possibly all financial planners regardless of geography has a common advice concerning investments. They say insurance and investment must not be clubbed. That means insurance plans that make investments in equity and debt in whatever proportion by allocation of the premiums paid must be avoided. They emphasize that insurance must be bought only to cover the loss that may be caused by the death of the bread earner in the family. In India, there is a product category called unit-linked insurance plan offered by life insurance companies. Most financial planners not merely recommend but advise that one must avoid these plans as they are a combination of investment and insurance. Here, I encourage the question, why? If we recommend a unit-linked insurance plan that not only provides a risk cover to the insured, secures the financial future of his dependents and invests money that will help him achieve his financial needs and goals should he survive for the term of the policy, how does it harm the client? Has the financial planner done any research? Has he the data to support the theory that insurance and investment must not be clubbed? Has he any own theory of why a unit-linked insurance plan is not good? I am not talking about the research done by some other professional or organization that is sold or handed over to an advisor or financial planner in a ready format, or some information that is freely available on the internet, but asking if the CFP has done his own analysis and verified whether such an insurance plan is right or wrong. This is something a CFP must contemplate. Coming to mutual funds in India, there are equity-oriented mutual funds, debt-oriented funds, and a combination of both called hybrid or balanced funds. Though big a word here to describe the practices of some financial advisors because, on one hand, while they say investment and insurance must not be clubbed by buying endowment or unit-linked insurance plans, on the other, they do not hesitate to recommend balanced or hybrid or structured funds. Most of them do not ask themselves why they should not invest equity funds and debt funds separately. Why should one invest in balanced funds that have some amount in debt? I am not proposing or opposing anything. All I am saying is that a CFP must do critical analysis, document it, and have a valid answer for every recommendation he makes. Customizing. A CFP must tailor the financial plan or investment advice to a client's personal needs. If not asked for merely to save time, a CFP does not always infuse alternatives in the plan for achieving each goal or need. Sometimes, after presenting a draft, if the client comes up with doubts and questions, only then does the CFP makes corrections and improvements to the plan and present it to the client as a final one. Why not give various possible options or alternatives or scenarios the first time itself instead of an incomplete draft? Why give a chance to the client to point out the gaps and make modifications later as though he did not know how to think? Or appear to the client as though he's thorough in his advice? Spend a little time. Give various alternatives to the client to achieve each financial goal comfortably. Value addition. A CFP must learn to generate advisor alpha and discuss it with the client. Financial planning is a timeless concept, but equity and interest rate markets are not so. They are dynamic and volatile. So, comparing the highest possible return with the expected return from asset classification is one thing a planner must consider. We discussed this earlier. If we put entire money in equity, what return will we get? If we go with asset classification after risk, what rate of return is achievable? What rate of return does a client need to achieve his or her needs and goals? If a client can achieve his goals even after investing in low risk and low return financial products, is it necessary to expose at least some portion of assets to high risk asset classes such as equity? Okay. Say, the client can achieve the goals by investing in debt that is presumed to have lower risk than equity, of course, in theory. Does that mean we can, and should, invest in debt? Merely because the client has no need to take risk? It is something we have to think. Let us take another example. Some financial advisors give some important star ratings of various mutual fund schemes and other investments given by rating agencies. And some advisors outrightly reject the ratings. My question is, does the CFP or the investment advisor know how credit rating agencies give ratings to various investments or financial products? Do you know their rating methodology? In India, there are a few reputed mutual fund rating agencies including Value Research Online, Morningstar India, and ICRA powered by Moody's. These agencies give star ratings and ranks to various investments. Has the CFP studied and researched various parameters based on which these agencies rate various equity or debt mutual fund schemes? Have you, a CFP or an investment advisor, done the research? Give it a serious thought. Mutual fund is a dominant financial product in India today. Maybe in numbers life insurance is a competition, but mutual fund has elevated itself to a superior position in the investment world. It is regarded as investments in India today. Now, what is happening is, whenever the implementation of a financial plan comes, the mind of a financial planner or a financial advisor immediately goes to mutual funds. It may not be the case with every advisor, but it is so with a majority of them. The question is, why? If such an importance for mutual funds alone. There are various other ways to invest in equity. If the client is a high net worth individual, a portfolio management service, and if he or she is a super HNI, a private equity investment or angel investing may be explored, studied and recommended. Or even a unit-linked insurance plan, if it is suitable to the client and worthy, may be recommended. The CFP can also take the responsibility of recommending direct equity instead of investing in a managed portfolio such as a mutual fund or a PMS or ULIP. The planner or advisor must get out of the limitations so as to not be typecasted and think beyond the commonplaces. Proactive. A CFP must not ignore the implementation, reviewing, and rebalancing of the portfolio and plan. A plan once submitted does not relieve the planner of the responsibilities. Most clients do not implement the plan immediately, which may defeat the very purpose of the plan should some contingency or a risk is encountered. A CFP must follow up with the client and encourage him or her to implement it immediately or as soon as possible. Periodically, the planner must check with the client and see if a review or modification of the plan is required. Also, at least once a year, or ideally twice a year, the financial planner must review and rebalance the portfolio recommended through the plan, to match it with the originally decided asset allocation strategy. That is how a financial planner must be proactive, and that is how he or she can justify the practicing of client. The Certified Financial Planner credential is the most desired and respected global certification for those seeking to demonstrate their commitment to competent and ethical financial planning practice. CFP professionals meet initial and ongoing education, experience, and professional development requirements. They pass a rigorous exam that assesses competency and adheres to a code of ethics. They pledge to provide financial planning in the interests of clients, and with the highest ethical and professional standards. So, imagine how efficient and competitive a financial planner must be. A CFP, from his education and experience, must produce new ideas, theories, and introduce innovative practices. Let us take an example for a discussion. Is defining financial goals essential? I mean, is it necessary to identify a financial goal? Quantify? Set the time horizon? And prioritize it? Suppose a client has a limited surplus to achieve his or her family's financial goals. Depending on the client's role, you have specified an asset allocation ratio for the client. Now, regardless of the term horizon of a goal, that is, whether a goal is due in the short term, or medium term, or long term, most financial plans do risk profiling, asset allocation, and recommend investments into various asset classes based on the asset classification ratio. These percentages are applied for each individual goal. One goal may be 5 years away. Another one may be 10 years away. Another may be due 15 or 20 years hence. irrespective of the time horizon of individual financial goals. Asset allocation is done commonly. And, for each goal, same asset attributed by financial planners or advisors. A CFP must critically evaluate if such a practice is right. If at all such a practice is acceptable. Is defining goals essential? Irrespective of the short-term, or medium-term or long-term nature of a goal. If we apply the same asset allocation commonly, whether or not you have clearly defined, quantified, and prioritized any goal, you are making the investment in all asset classes commonly in the given proportion. Why and how does it matter what the goal is and what the time horizon is? The investment will perform based on the asset class and whenever a need for money arises. The investor makes a withdrawal from the pool meant for all goals that have a common asset allocation ratio. Why is it necessary to define a goal? If this argument has to be proved wrong, what has to be done is, the same asset allocation ratio must not be fixed for all goals, which have varying time horizons. Again, in such a case, the concept of asset allocation itself being put into the plan by financial planners will be wrong. What is the point of asset allocation if the ratio is different for each goal depending on the time horizon? This is why I earlier said that just because something is being done by someone does not mean we need to replicate and follow it. Every financial planner does risk profiling for clients through a questionnaire and does asset allocation for all goals as per the same allocation. In theory, when this discussion happens, a CFP usually says medium-term goals must have medium-risk financial products allocated to them, high-risk products for long-term goals, and low-risk investments for short-term goals. And they all say it, but in practice they do differently. A CFP professional must come up with ideas like T.S., critically review them on his own, share such ideas with peers, discuss the practical application of such ideas, understand the pros and cons of such new practice, and then if such new idea is generally considered acceptable, he or she must propound it, spread it, talk about it in open forums, train students on such thoughts and processes, educate clients, explain this new theory to them, and if clients are comfortable, implement the idea. That is how a CFP must innovate if he is keen about putting his client's interests before his own. To conclude, every CFP must act as a fiduciary to his client. Meaning, the CFP must always act in the best interest of the client and seek the best price and terms for the client while recommending, investing, or buying financial products. How can that be achieved? How can one ensure that he or she is a fiduciary? Through learning. Through continuing education. By following the code of ethics and being compassionate to the financial needs and position of the client. That is how a CFP must be as a fiduciary. A financial planner must remember that if a client hears about a new practice, information, or a new strategy about investing or financial products or personal financial management that affect his plan and achievement of needs and goals, it is you, his advisor or planner, that he or she must hear from. The client must not hear this from someone else but from you first. That is how proactive a CFP must be. That is what it means to be a fiduciary and a client-first CFP. I hope you have understood the gist of the client-first principle or the code of ethics. I say, client-first must become a personality trait of every CFP, rather than being imposed by regulations or the code of conduct or ethics. This is what it means to be a true professional. My name is Venkatesam. Thank you for attending this webinar.